Insurance was supposed to protect you. Somehow, it became a trillion-dollar trap. Today, the industry makes record profits while denying more claims than at any point in modern history. Premiums go up, coverage shrinks, and the moment you actually need help, the system quietly switches sides, not by accident, not because the system is broken, but because modern insurance is designed to pay out as little as possible. This video uncovers how the insurance industry flipped its incentives, how algorithms replaced fairness, how corporations rewrote the rules, and how ordinary people ended up funding one of the most predatory profit engines in the country. Most people don't realize it yet, but the truth is simple. Insurance companies don't make money when they help you. They make money when they don't, and once you understand that, the entire industry snaps into focus. The delays, the denials, the endless paperwork, the fine print, the phone calls that go nowhere. It's not frustration, it's strategy. Insurance sells you peace of mind, but behind the scenes, it has evolved into something entirely different. A machine built to extract, avoid, and protect its bottom line at all costs. To understand how we got here, you have to look past the commercials, past the slogans, past the friendly mascots and smiling actors promising they're on your side. Because behind all that branding, the moment you file a claim, you stop being a customer and you become a cost. And costs in a trillion-dollar industry are meant to be minimized. But the transformation didn't happen overnight. Insurance began as something completely different. Before corporations, before Wall Street, before industry giants shaped the rules to their advantage, insurance was built on community. If your barn burned down, the town rebuilt it. If your crops failed, your neighbors helped you survive. Mutual aid wasn't a business model. It was a lifeline. Early American insurance companies were extensions of that same philosophy. Members paid into a shared pool, and losses were covered fairly. Policies were short, written in plain language, and based on trust. Claims were simple. Executives weren't earning 8-figure bonuses. Shareholders didn't exist. Insurance wasn't a profit center. It was a promise. But as America industrialized, that promise became an opportunity. Railroads, factories, shipping companies, all of them needed protection from risk. And the more risk there was, the more money could be made selling protection against it. Insurance drifted away from mutual support and towards something else, a business, a very profitable one. By the early 20th century, the shift was complete. Insurance companies weren't communities anymore. They were corporations. And like every corporation, they weren't judged by how well they protected people, but by how much money they generated. That's when a brutal realization took hold. The best way to increase profits wasn't to insure more people. It was to pay out less to the people they already insured. Every claim denied was money saved. Every delay created more investment time. Every loophole became a hidden revenue stream. And slowly, quietly, the industry rewrote the rules of the game. Policies became more complex. Contracts grew longer. Exceptions grew broader. The language shifted from clear and human to legalistic and impenetrable. Insurance became something you needed a lawyer to understand. And behind all of it was a simple truth. A confused customer is a profitable customer. But the real turning point, the moment insurance fully evolved into the machine we know today, came when companies realized they could do more than minimize payouts. They could engineer the entire process around avoiding them. That's how one of the most infamous strategies in insurance was born. Delay, deny, defend. Delay the claim as long as possible. Deny the claim at the first opportunity. Defend that denial relentlessly if the policyholder pushes back. Most people won't fight. Most don't know how. And many simply can't afford to. This strategy was so effective that some insurers created entire teams dedicated not to evaluating claims, but to rejecting them. In some companies, adjusters were given target numbers, quiet quotas that determined how much could be paid out and how much needed to be reduced. Performance wasn't measured by fairness, it was measured by savings. One former industry insider, quoted in a publicly documented investigation, described the training like this: "We weren't taught to help people, we were taught to find reasons not to." That mindset didn't stay in one corner of the industry, it spread everywhere. Home insurance, auto insurance, health insurance, even life insurance. And once insurers realized how much money they could save by denying claims, they went one step further. They turned to technology. Auto insurers were among the first to adopt algorithmic claims evaluation. Some of the biggest companies in the country were found using internal software to automatically flag and reject thousands of injury claims without a human ever looking at them. Entire categories of claims were labeled suspicious, low probability, or unlikely to challenge, not based on evidence, not based on investigation, based on likelihood of pushback. Deny the people least likely to fight. In the aftermath of natural disasters, the pattern became even more visible. During a historic wave of California wildfires, numerous homeowners discovered that after decades of paying premiums, their insurers refused to rebuild. Some companies pulled out of entire regions. Others used obscure clauses buried deep in policy language to avoid covering full damages. And in some cases, insurers dropped customers entirely after they filed a claim, deciding they were too expensive to keep. Imagine losing everything you own, and then losing your coverage too. But nowhere is the harm more devastating than in health insurance, the sector that affects life and death the most. Health insurance is now one of the most profitable industries in the United States. Some of the largest health insurers bring in more revenue annually than the biggest tech companies. And yet the business model remains the same. Make money by denying care. In several public investigations, major insurers were documented using automated systems to deny claims in bulk. Not hundreds, not thousands, hundreds of thousands. Claims rejected in seconds, with doctors left stunned and patients left desperate. Insurers called it efficiency. Doctors called it exactly what it was: abandonment. In one widely reported investigation, a physician employed by a major health insurer denied thousands of medical claims in a single month, often spending mere seconds on each review. Seconds. Behind these decisions were real people: cancer patients, chronically ill patients, families trying to keep someone alive, all treated as data points in a spreadsheet. Another investigation revealed that several Medicare Advantage insurers, including some of the biggest players in the country, were accused of inflating patient diagnoses to increase payouts from the government, while simultaneously denying care to those same patients. Regulators found extensive patterns of overbilling and wrongful denials. More diagnoses meant more revenue. More denials meant lower costs. A perfect business model built on a perfect contradiction. In 2022, one Medicare Advantage insurer paid hundreds of millions to settle allegations related to fraudulent overcharges, charges that came at the expense of taxpayers while patients struggled to access basic services. These aren't isolated incidents. They're symptoms of an industry that learned how to turn vulnerability into profit. By now, the pattern should be clear. Insurance companies don't fear your tragedy. They fear your payout. And that fear drives everything. It's why adjusters nitpick every detail. It's why documents get lost. It's why calls go unanswered. It's why policies are filled with traps you only discover after disaster strikes. It's why insurers fight their own customers harder than they fight fraud. Because every dollar they don't pay you is a dollar they keep. But the most disturbing evolution of all is the rise of algorithms, systems trained not for fairness, but for savings. One major health insurer was documented using an AI model that automatically denied rehabilitation claims for elderly patients recovering from surgery. The moment the algorithm decided a patient had reached the expected recovery time, coverage stopped, even if doctors insisted therapy was still medically necessary. Families were forced to pull loved ones out of care prematurely. Some deteriorated. Some were permanently harmed. All because a machine, not a doctor, decided they were done. Insurance companies insist that these tools are designed to improve accuracy and reduce fraud. But when algorithms are trained on cost-saving patterns, denials become the default. A machine doesn't care about context. A machine doesn't listen to doctors. A machine doesn't see human beings. A machine sees expenses, and expenses must be eliminated. The irony is that insurance companies still present themselves as protectors, smiling actors, relatable mascots, soft lighting, soothing music. But behind the curtain, they're running a financial empire that depends on your vulnerability and thrives on your ignorance. The system has become so convoluted, so intimidating, so exhausting, that millions of people simply give up the moment they hit resistance. That's not an accident. That's design. If you've ever wondered why filing a claim feels like stepping into a maze, why the rules seem to change every time you call, why you're passed from one representative to another, why the forms never end, why the smallest mistake voids your coverage, why you're made to feel like the burden, it's because the system works best when you quit. Insurance is mandatory for many parts of life. You can't drive without it. You can't get a mortgage without it. You can't navigate the healthcare system without it. The industry knows this, and it uses that knowledge to its advantage. This isn't a safety net, it's a fortress. And customers are on the outside. And yet, despite everything, the insurance machine continues to grow, more profitable, more automated. more entrenched in everyday life. But pressure is building. In the next chapter, Part 2, we're going deeper into the cracks appearing inside the machine, the climate crisis insurers are fleeing from, the reinsurance markets rewriting your premiums, the coming affordability collapse, the AI systems primed to take over, and the future that could force millions into a world where protection becomes a luxury. Because the insurance crisis isn't coming, it's already here. The cracks in the insurance machine aren't just showing, they're widening. And nowhere is that more obvious than in the places where insurance companies have quietly begun to retreat. For generations, home insurance was considered one of the most stable, predictable sectors in the industry. Companies collected premiums, paid occasional claims, and remained profitable. But then nature changed. Fires became bigger, hurricanes became stronger, floods became more frequent, storms became more destructive, and suddenly the numbers didn't look the same. Insurers began to make a chilling calculation. If the risk of paying claims becomes too great, simply stop covering the risk. That's exactly what happened in California. When back-to-back wildfire seasons destroyed entire communities, insurers responded not by expanding protections, but by running. They stopped writing new policies in fire-prone areas. Then they non-renewed existing customers. Then they raised premiums dramatically in regions that had never seen major fires at all. Families who had paid faithfully for decades were told, "Your home is no longer insurable." Not because it burned down, but because it might. It wasn't personal, it was math. But to the families who lived there, it was betrayal. Protection, once guaranteed, had become conditional, and the conditions were changing faster than anyone could adapt. Florida faced the same reckoning. After a series of devastating hurricanes, multiple insurance companies collapsed outright. Others fled the state entirely. The ones that remained raised prices so aggressively that many homeowners saw their insurance bills double or triple in a single year. Some insurers were later investigated for underpaying claims by as much as 80–90%, offering totals so low that families couldn't begin to rebuild. Imagine losing your roof, your walls, your belongings, and being told by your insurer that the damage was worth almost nothing. In some cases, homeowners ended up in years-long legal battles simply to get what they had already paid for. The message was unmistakable. When profit is threatened, protection evaporates. But behind these retreating insurers is something even larger, something most people never hear about, yet it controls the entire insurance economy. Reinsurance. Reinsurance companies are the insurers for insurance companies. They're the ones who take on the biggest risks, the most catastrophic losses. The events so massive, one insurer can't handle them alone. For decades, reinsurance was affordable and stable. But as climate disasters intensified, so did reinsurance costs. And when reinsurers raise prices, insurers raise prices even higher. They pull out of markets. They restrict coverage. They narrow policies. They deny more claims. Because if reinsurers won't protect the insurers, then the insurers won't protect you. This top-down collapse explains why entire states are now facing insurance crises, why homebuyers are being denied mortgages due to lack of coverage, why policies are shrinking while premiums explode, and why millions of Americans are one disaster away from financial ruin. Insurance companies insist the climate is becoming uninsurable. But somehow their profits keep rising, because rather than cover the losses, they simply transfer the risk back to customers through higher deductibles, reduced coverage, stricter exclusions, and mass cancellations. The machine adapts, just not in your favor. But this isn't just a housing story. It's a health story, an auto story, a financial story, a national story. Because at the heart of the modern insurance industry is the same principle: minimize payouts at every level, through every tool, at every opportunity. And nowhere is that clearer than in the rise of algorithmic denial systems. We've already seen how some auto insurers used software to undervalue injury claims, but health insurers have taken it even further. One major insurer used an internal AI model to automatically reject coverage for elderly patients in rehabilitation facilities. The model determined, based on statistical averages, how many days of therapy a patient should need. And once they hit that average, even if they hadn't recovered, coverage ended. Doctors begged for more time, families pleaded, patients suffered. But the algorithm didn't budge. The machine decided they were done. Another investigation revealed that health insurers were using predictive analytics to preemptively deny treatments before doctors even submitted documentation. Essentially, if the system predicted the insurer would likely deny the claim anyway, it simply denied it faster. This wasn't about fraud prevention. This was about friction creation. If a claim is denied quickly, some people won't appeal. If they don't appeal, the insurer saves money. And if savings increase, shareholders are pleased. The system rewards efficiency, but only the kind of efficiency that reduces payouts. Appeals processes, by contrast, are anything but efficient. They're slow, confusing, inconsistent, and exhausting by design. Most people don't understand how to appeal a denial. Even fewer have the time, energy, or financial stability to fight a billion-dollar company equipped with lawyers, algorithms, and automated defenses. The imbalance of power isn't incidental, it's structural. And yet, despite the sophistication of denial systems, insurers have maintained one of the simplest, most profitable illusions in the world: the illusion of choice. Technically, you can choose your insurer, but in reality, the industry has consolidated so heavily that most Americans are choosing between a handful of mega companies with nearly identical policies, nearly identical exclusions, nearly identical loopholes, and nearly identical prices. It feels like competition on the surface. Underneath, it's uniformity. And these same companies spend billions lobbying lawmakers to ensure the rules never shift against them. They lobby to restrict lawsuits. They lobby to enforce mandatory coverage. They lobby to limit regulatory oversight. They lobby to keep arbitration clauses in place. They lobby to weaken consumer protections. They lobby to prevent transparency in pricing. And they do it because the stakes are enormous. Insurance is one of the few industries where customers are required by law to buy the product, but the company is not required by law to provide the outcome customers think they're paying for. You must purchase it, but they choose whether to honor it. Nowhere is this contradiction more devastating than in health insurance. Health insurers generate record profits year after year, even as doctors report widespread denials for essential treatments, medications, and tests, even as patients delay care because of cost, even as life or death decisions are outsourced to algorithms and rubber-stamped by physicians who never see the patient. The more denials, the more savings. The more savings, the more the stock price rises. The higher the stock price, the bigger the executive bonuses. In this system, your well-being isn't the priority, it's the expense. Life insurance has its own dark corner. Policies can be voided for reasons buried deep in the fine print: misstatements, paperwork errors, medical omissions, or inconsistencies. There are cases where families expected a payout after a loved one's death, only to discover the policy included a clause that made it worthless. Imagine paying premiums for 20 years, only to have your family receive nothing. Disability insurance, too, has been riddled with scandal. In publicly documented lawsuits, some insurers were accused of using biased medical reviewers to declare claimants fit for work, even when their own doctors said otherwise. In some cases, these reviews lasted mere minutes, not enough time to evaluate anything. But the biggest shift, the one that will define the next decade, is the transformation of insurance from a protective service into a financial instrument. Today, insurers make far more money investing premiums than paying claims. They collect your money up front, invest it immediately into the markets, and earn returns long before they ever consider paying a claim. Your premiums don't just sit in an account. They fuel massive investment portfolios. And your denied claims? They become profit margins. This financialization has fundamentally inverted the purpose of insurance. What was once a shared risk pool has become a profit engine. And as long as denial increases profit, denials will continue to grow. But there is a new force emerging. Something far bigger than any algorithm, any company, or any regulation: the future. The insurance crisis is about to enter a new phase, one driven by forces that will reshape everything we've talked about so far. The first force is climate change. Insurers are already withdrawing from high-risk states, but as disasters become more frequent, more regions will become uninsurable. Not because people don't need insurance, but because insurers don't want the risk. If entire states become unprofitable, insurers will leave. If they leave, mortgages become impossible. If mortgages become impossible, housing markets collapse. A world where you can't insure a home is a world where you can't buy one. The second force is AI. Algorithms already deny claims, but the next generation of systems will go further, predicting which customers are likely to get sick, which drivers are likely to crash, which homes are likely to burn, and adjusting premiums accordingly. On the surface, it sounds efficient. In reality, it's discrimination at scale. AI will price people out of protection long before they ever file a claim. Some will be deemed too risky to insure. Others will be offered policies so expensive they might as well not exist. Insurance will shift from being a universal safety net to a stratified privilege, accessible to those with wealth, denied to those without. The third force is political pressure. As premiums explode and coverage collapses, the public will demand reform. Some states will attempt to regulate, others will attempt to create public alternatives. But the insurance lobby will fight back with everything they have. The industry's survival depends on maintaining the current model, a model where customers pay more, get less, and surrender control without realizing it. The fourth force is generational. Millennials and Gen Z are already paying more for insurance than previous generations, for homes they can't afford, cars that cost more to repair, and healthcare that grows more expensive every year. Younger generations are entering a world where insurance is mandatory but inadequate, a world where protection has become a luxury, where risk is privatized, where safety comes at a price they can't pay. The final force, the one almost no one sees coming, is trust. Insurance depends on belief. Belief that companies will honor their promises. Belief that coverage means protection. Belief that help will come when disaster strikes. But belief is fragile. Every denial weakens it. Every cancellation cracks it. Every scandal shatters it. And once trust collapses, the entire industry collapses with it, because a system built on promises cannot survive when people stop believing the promises. If there is one lesson in this entire story, it's this. The insurance crisis isn't about paperwork. It isn't about policies. It isn't even about premiums. It's about power. Who has it? Who doesn't? Who benefits? Who pays? For decades, the insurance industry has used complexity, confusion, and corporate machinery to hide a simple truth. The safest businesses in the world are the ones where customers are required to pay, but the company is not required to deliver. Most people assume the system is broken, but it isn't broken. It's working exactly as designed. Insurance doesn't exist to protect you. It exists to protect itself. And now you finally understand the machine. So the next time you see a commercial with a friendly mascot promising that they're on your side, remember what you've learned, because behind the smile is a business model that thrives on denial, grows on confusion, and profits from your worst moments. A model that has turned risk into revenue, suffering into savings, and protection into profit. This is the insurance scam running your life. And now that you know how it works, you'll never look at a policy or a promise the same way again. For more insight into the hidden corporate powers governing our society, like and subscribe.